Nobody warned you about this mistake. It didn't happen in a single moment. There was no bad decision, no reckless gamble, no obvious turning point where you could have chosen differently. It happened slowly, quietly, across hundreds of small, reasonable, completely normal choices that individually made perfect sense. And by the time most people discover it, usually sometime in their 40s or 50s when they sit down to seriously calculate their retirement, the damage is already done. $200,000. Gone. Not stolen, not lost in a crash, not spent on anything dramatic, simply evaporated through the compounding cost of decisions that felt responsible at the time, decisions that millions of middle-class households make every single year without anyone ever explaining what they actually cost. Here is what makes this particularly painful. The people who make this mistake are not the financially reckless ones. They're not the people who never save, who live entirely for today, who ignore money entirely. Those people have different problems. The people who make this mistake are the responsible ones, the ones who pay their bills on time, who have some savings, who think about their financial future, who are, by every conventional measure, doing the right things. They just don't know about this one thing, and this one thing costs them $200,000. Today, we are going to name it, explain it, quantify it, and show you exactly how to stop it from taking the rest of what it would have taken from you. Let's go. The $200,000 mistake is not one single action. It is a pattern, a cluster of financially costly behaviors that virtually every middle-class household engages in, behaviors that are so normalized, so universally practiced, so culturally embedded that questioning them feels almost eccentric. The pattern has a name: financial friction costs. Financial friction is the money lost not through bad investments or reckless spending, but through inefficiency, through paying more for the same outcome than necessary, through choosing the path of least resistance when a slightly less convenient path would have cost dramatically less. Financial friction operates across 6 specific categories, and most middle-class households are losing money in all 6 simultaneously. Let me show you each one, then we'll add them up. The total will not be $200,000. It will be significantly more. The first and largest source of financial friction for most middle-class households is deceptively simple: having the right accounts, but not using them correctly. Most middle-class Americans have access to a 401k. Many have one open, but according to Vanguard's annual How America Saves report, the median 401k contribution rate among participants is approximately 7.4% of income. The employer match threshold at most companies is 6%, which means the typical worker is contributing just enough to capture the match, and then stopping. Here is what that 1.4% above the match represents in dollar terms over a career. On a $65,000 salary, 7.4% is approximately $4,810 per year. The maximum 401k contribution in 2026 is $24,500. The gap between what the average worker contributes and what they could contribute is approximately $19,690 per year. Now, most people genuinely cannot contribute $24,500 per year. Budget constraints are real. This is not a criticism. But here is the specific friction cost. The average middle-class worker who contributes 7.4% instead of, say, 15%, a more aggressive but achievable target, is leaving approximately $4,940 per year in uninvested capacity on the table. $4,940 per year, invested at 10% annual returns over 25 years, approximately $490,000. Not investing this money doesn't mean it stays in your bank account. Research consistently shows that money not automatically redirected to investments gets absorbed by lifestyle spending within 90 days. It disappears into the same budget categories that already exist: restaurant spending, convenience purchases, subscription creep. The friction cost isn't the $4,940, it's the $490,000 it would have become. But this is just the first category. Let's keep going. The second friction cost operates inside accounts that are already open, silently extracting wealth through fees that most investors never notice because they're never explicitly charged. The average actively managed mutual fund charges an expense ratio of approximately 0.66% annually according to Morningstar's 2024 fee study. Many charge 1% or more. Target date funds, the default option in many 401k plans, often charge between 0.1% and 0.75% depending on the provider. The lowest cost index funds charge 0.03%. The difference between 0.66% and 0.03% is 0.63 percentage points annually. On a $200,000 portfolio, that's $1,260 per year in additional fees. Invisible, automatic, never explicitly charged, simply taken from your returns before they're reported. Over a 20-year accumulation period, starting with $50,000 and adding $500 mo. NTHLY, the difference between a 0.66% expense ratio and a 0.03% expense ratio at 10% gross returns is approximately $87,000. On a larger portfolio or longer time horizon, the fee drag exceeds $150,000 to $200,000 easily. And this is the friction cost for investors who are already investing. They're doing the right thing. They just didn't know that the fund their HR department defaulted them into charges 22 times more than the alternative, for a service that underperforms the alternative in approximately 92% of cases. The fix is 3 minutes of work. Log into your 401k. Check the expense ratios of your current funds. Switch to the lowest cost index fund options available in your plan, typically labeled index, and charging under 0.1%. Done. 3 minutes. Potentially $150,000 to $200,000 recovered over your investing lifetime. The third friction cost is the one most middle-class investors never think about, because it requires understanding not just what you invest, but where you invest it. Asset location, the practice of placing different types of investments in accounts based on their tax treatment. Most investors with both tax-advantaged accounts, 401k, Roth IRA, and taxable brokerage accounts hold the same types of investments in all accounts. They don't think about which investments should be where from a tax perspective. This costs them money every year. Here is the basic principle. Investments that generate significant taxable income, bonds, REITs, dividend-heavy funds, should be held inside tax-advantaged accounts where that income isn't taxed annually. Investments with lower taxable income generation and higher growth potential, broad equity index funds, can be held in taxable accounts more efficiently because their tax impact is lower and more controllable through tax loss harvesting. A middle-class investor with $150,000 in a taxable brokerage account holding a bond fund, yielding 4%, annually generates $6,000 in taxable interest income per year. At a 22% marginal tax rate, that's $1,320 per year in unnecessary taxes, on income that should have been sheltered inside a tax-advantaged account, where the same bond fund would generate zero annual tax liability. $1,320 per year in avoidable taxes, invested instead at 10% returns over 20 years, approximately $83,000. Tax inefficiency is an invisible annual fee that never appears on any statement, but costs the same whether or not you notice it. The fix requires simply reviewing which asset types live in which accounts and moving tax-inefficient assets inside tax-advantaged accounts where possible. A one-time portfolio review with this lens can save thousands per year indefinitely. The fourth friction cost is one that virtually every middle-class household is paying, and virtually none have reviewed in the past 3 years. Insurance overpayment. Auto insurance, home insurance, life insurance, and various supplemental insurance products are among the most overpriced recurring expenses in middle-class budgets, not because insurance itself is unnecessary, but because most people set their coverage once and never revisit it. Insurance companies do not proactively offer you lower rates when you become a lower-risk customer. They do not call you when a competitor offers the same coverage for 30% less. They charge whatever you agreed to pay when you first signed up, plus annual increases, until you cancel or shop around. J.D. Power's 2025 Auto Insurance Study found that customers who had been with the same insurer for more than 3 years paid an average of 18% more than new customers for equivalent coverage. On an average annual auto insurance premium of $2,100, that's $378 per year in loyalty penalty. On homeowners insurance averaging $1,900 annually, another loyalty penalty of approximately $342 per year. Combined insurance overpayment from not shopping coverage regularly, approximately $720 per year conservatively. Invested at 10% over 25 years, approximately $85,000. Beyond loyalty penalties, most households carry coverage levels set years ago without reviewing whether those levels still match their actual risk and asset profile. Deductible levels set too low. Because a low deductible felt safe when first established, cost hundreds of dollars per year in higher premiums for coverage that statistically you will rarely use. The fix: spend 90 minutes every 2 years comparing insurance quotes. Adjust deductibles to match your current emergency fund level. If you have a $5,000 emergency fund, a $2,500 deductible is appropriate. Review life insurance need against current assets and liabilities. Cancel coverage that duplicates what you already have. Friction cost 5. Consumer debt interest. The average middle-class household carries approximately $6,000 to $8,000 in credit card debt at any given time, according to Federal Reserve consumer credit data. At an average credit card interest rate of approximately 21.5% in 2025, that's $1,290 to $1,720 per year in pure interest expense. Interest on consumer debt is the definition of financial friction. It produces nothing. It builds nothing. It is money paid for the privilege of having spent money you didn't have yet, a guaranteed negative return on that portion of your financial life. $1,500 per year in credit card interest, redirected to investments at 10% over 25 years, approximately $177,000. But the friction cost goes deeper than the interest payments themselves. The existence of consumer debt creates a psychological anchor that reduces investment confidence and contribution rates. People carrying credit card debt are significantly less likely to increase investment contributions, even when they could afford to, because the debt creates a persistent sense of financial insecurity that suppresses investment behavior. The psychological cost of debt, separate from the interest cost, produces measurable reductions in wealth accumulation that are difficult to quantify but consistently documented in behavioral finance research. Eliminate consumer debt aggressively, completely, then redirect every dollar that was going to interest payments into investment contributions. The interest rate on credit card debt is 21%. The expected return on a diversified index fund is 10%. Eliminating the debt is the highest guaranteed return investment available. Friction cost 6. Uninvested cash drag. The final friction cost is the most subtle, and in some ways the most insidious, because it affects people who are doing almost everything right. Cash drag is the wealth lost by holding more cash than your emergency fund requires, in savings accounts, money market funds, or checking accounts earning below the market return. According to Vanguard research, the average investor holds approximately 8 to 12% of their total financial assets in cash or cash equivalents, beyond what emergency fund needs would justify. For a household with $200,000 in total financial assets, that's $16,000 to $24,000 in excess cash, earning 4%, instead of the market's historical 10%. The annual opportunity cost on $20,000 of excess cash, approximately $1,200 per year, the 6% difference between what the cash earns and what it could earn in an index fund. Over 25 years, that $1,200 annual opportunity cost compounds to approximately $118,000. This is the friction cost for people who feel financially responsible because they have substantial savings. They are responsible. But responsibility without optimization still costs money, it just costs it quietly. The fix: define your emergency fund target precisely. 3 to 6 months of essential expenses in a high-yield savings account. Everything above that amount belongs in investments, not because savings are bad, but because every dollar above your emergency fund target is earning less than it could with complete certainty. Let's total the friction costs we've identified, using conservative estimates for a typical middle-class household over 25 years. Under contribution to tax-advantaged accounts, $490,000 in foregone growth. High-fee investment products, $87,000 to $200,000 in excess fees compounded. Tax inefficiency from wrong asset location, $83,000 in avoidable taxes compounded. Insurance overpayment, $85,000 in excess premiums compounded. Consumer debt interest, $177,000 in interest and suppressed investment behavior. Uninvested excess cash, $118,000 in opportunity cost compounded. Total friction cost over 25 years, $1,040,000 to $1,153,000. Over $1 million. Not from reckless decisions, not from bad investments, not from a single dramatic mistake. From 6 categories of quiet, invisible, normalized inefficiency, each individually forgivable, collectively catastrophic. Now, no single household is losing maximally in all 6 categories simultaneously. Real situations are more nuanced. The overlap between these costs means the true total is not simply additive. But the point is this: $200,000 is not the upper bound of what financial friction costs the average middle-class household over a working lifetime. It is closer to the floor. The people who eliminate financial friction systematically, who optimize their contribution rates, minimize fees, practice tax-efficient investing, review insurance regularly, eliminate consumer debt, and keep only their true emergency fund in cash, arrive at retirement with dramatically more than they're equally saving peers who never learn to look for the leaks. Here is what I want you to do this week. Not all of it, just the highest impact actions from each category. Log into your 401k today. Check the expense ratios on your current holdings. Switch to the lowest cost index fund option available. This takes 3 minutes and may save you $150,000 over your investing lifetime. Pull up your last 3 credit card statements. Calculate exactly how much interest you paid last month. Multiply by 12, that is your annual FR. Action cost from consumer debt. Make eliminating it a specific, dated goal, not a vague intention. Call your auto and home insurance providers. Tell them you're shopping for lower rates. Most will offer a retention discount immediately. If they won't, get quotes from 2 competitors. The 90 minutes this takes has historically returned $300 to $700 per year for most households. Calculate your emergency fund target, 3 to 6 months of essential expenses. Look at your savings account balance. Everything above that target is investable money currently earning below its potential. Move it. 1 action each week for 4 weeks. 4 categories addressed. Potentially hundreds of thousands of dollars of friction costs eliminated permanently from your financial life. The mistake wasn't dramatic. The fix doesn't have to be either. You didn't know, now you do.